Go to our first Wednesday session from the Founders Fight Club in cooperation with STYX Urban VC. We are so looking forward to having Erik here on stage with us. What am I to say? You all may have heard, once you build a startup, the first thing you gotta be doing is always be fundraising. You gotta get some money in there to build your startup, build your product. But on the other hand, people may say, never fundraise, keep it all to yourself, fundraise as late as possible so you don't dilute your shares and you get to keep as much of your business as possible. With that being said, we are so looking forward to actually hear from the man himself, from Erik, what he thinks as a venture capital provider, especially to early stage founder. Now, maybe a few things you need to know. STYX are our best friends in VC world for all things built environment. They're incredibly founder friendly. You definitely have a VC on your side if you pair up with them, which is why I love to invite him today on our stage and take you through what an early stage investor's thoughts are, how they contemplate to invest into your case, and what may be some best strategies when thinking about investing, searching investing, or providing investment if you're on the other side of things and maybe you're living as an angel investor or want to get there. If you do have any questions, it doesn't matter whether you are on YouTube or on LinkedIn and watching us there, just let us know, and we are happy to answer all the questions that we get in the chat. And with that, without any further ado, Erik, the stage is all yours. Who are you, what do you do, and what do you have in store for us today?
Hi, Jan. Thanks for the kind words and for the warm introduction. So I'm Erik, I'm 29. I'm with STYX together with my two colleagues, Florian and David. And 6 years ago, we started investing in startups. I've done about 24 investments up till today. And I hope to, in the short time that we have today, change your mind about venture capital about 180 degrees. So I will try to spend the next 20 minutes to talk to you about why you should not raise venture capital, or why you should be wary about it, and what to watch out for, and especially to watch out for whom you're speaking to. And then towards the end, try to share try to share some inside knowledge on if you decide to raise venture capital after all, what are some things to take into consideration in terms of code of conduct, in terms of speaking and engaging with the venture world. So all that being said, let's jump right in. And Jan, you let me know if there's questions popping up. I understood we'll do a short Q&A, and I'll try to keep this to about 20 minutes to not wander off track too much. So let's go. Maybe to start in, I brought some bullet thoughts. How have you, or like most of you, have been able to engage with venture capital? Where have you heard about it, read about it? Probably in the startup press. What gets reported in the startup press? There's news about this 10 million pre-seed round being raised somewhere, or you hear on LinkedIn that people raise a lot of money. Honestly, I always feel bad for the people when I read those announcements, because it's if you start raising and you have raised 10 million, that's when the work starts, and that also puts you down the venture track. More on that later, but that's shouldn't be necessarily a sign of success. How do we arrive usually at those large valuations, those huge rounds? It can be a bit of a media and ego problem. People think big valuations are great. That's not necessarily the case. And lastly, I want to touch on who hands money to young businesses and why. But that's the three themes of the brief impulse input today. So as I've said before, the best funding is no funding. I'm trying to convince you to not waste money from venture capital. But if you do, these might be some reasons. I mean, you're entrepreneurs. why do you end up looking for venture? I mean, I don't have to go through that, but there's just a lot of costs initially. You need to develop your solution. You need to do marketing and sales. There's operational costs, and there's also some amount of uncertainty. And well, what do you get through funding? You get the finances. Maybe you get some strategic value adds through your investor, and it also provides you some buffer, some certainty to have a partner on your side and to have the money in the bank so you can focus on executing. So these are all very convincing reasons to do raise money after all, or why some people end up looking for money. Where can you look for money? Well, you can always look for money in a non-dilutive way, some soft funding, some grants. You can go to a bank if you want to open an ice cream store, or if you open a kebab store. You're not going to raise venture capital. You're still an entrepreneur, but those are classic businesses. You can go to a bank and ask for a loan, and if you can, and a bank is able to fund your business, go for it, and don't go and give away part of your pie. Don't go down here and raise equity. And equity and the convertible debt converting into equity are the two ways of fundraising we're going to focus on today. Convertible debt is basically the initial, or I would say the starting drug into equity, into an equity raise. It's the easiest way to get initial money in your company, usually in an angel round. It's a way to avoid a notary appointment, because you just raise money that transfers into equity later, and an equity would then be later on in a venture term sheet. Maybe to distinguish those two from each other, convertible loan and equity financing. Basically, convertible debt is a loan today, shares tomorrow. So you sign a short-term loan that converts into equity in the future, and the investor pays you money right now, and at the next fundraising round, the money invested converts into shares, usually at a small discount to the price of the later round. But it also solves that's one of the attractive parts. It solves the problem of having to agree on a valuation. You just started. It's really tough to put a price tag on your company. With a convertible note, you can say, hey, let's convert at a future point, and then at the price that we will agree on in the future with further external investors once we have a bit more meat on the bone. Basically, in 4 steps, the startups receives the funds. There's no exchange of equity. There's a trigger event like a funding round, and then the loan converts into shares at the discount. These are a couple of key terms you should watch out for, but maybe we can get on that in the Q&A, but let's not dive too deep into that at this point in time. On the other hand, a bit later in the process, a real equity round, that would be, what would you receive? You would receive a term sheet from a VC. In short, what will this term sheet entail? It will basically, it's a short form of the later shareholder agreement, an investment and shareholder agreement, sort of like a short term, or like a short version of a contract to be agreed on, and equity financing. What you do, you negotiate the terms of a term sheet, then the term sheet is signed. You go through a due diligence process, and then afterwards you go and have a final investment agreement. And what happens there is you have new shareholders, and those come into a new share class, and there's going to be new rules. So with an equity investment, there's always going to be a new shareholder agreement. So you'll have to talk about not just valuation, but also there's going to be adaptations to the governance of your company. So that's really not only are you giving away part of your company's pie, but also you're really you're no longer the sole owner of your company. You're not the only one making the rules. There's going to be either a board that has certain rules. There's going to be shareholders who might have a veto on certain decisions. You might have to argue on budgets, on hirings, etc. So that's really, it's a step you really want to be sure to take. It's not something to do lightly. And once you have someone in your company, it's really tough to get them back out. So alone you just pay back. Someone whose shares of your company is part of your company, and that's really a decision not to take lightly. A couple of considerations on why you, or when thinking about structuring your fundraising and what type of funding you should go for. The first would be stage and capital needs. There might be business models for which venture is the only way, and there's business model for which debt is sufficient. I was speaking about clearly understandable business models with clear risks that are known, like an ice cream store, or a bike store, something like that. Venture is usually for business models that a bank can't finance. Something that's a bit more risky, that's a bit uncertain. It's a new type of technology that's not proven yet, and then you should then you might want to consider venture. But even then, the question is it something I can grow step by step over time, like an agency or like a business model that's going to create cash flows right now, or it doesn't really matter if I win in 2 years or in 3 years or in 5 years, it's going to be a business that's steadily building. Then don't go for venture, build it from your own balance sheet and build it step by step. If circumstances under which you might want to consider raising from a venture investor would be, hey, you're raising, for example, with a time constraint. There's a lot of competitors coming up in the very same segment, and you really need to scale fast to have a chance to succeed. You need to cover as many markets as early as possible, for example. Then raising high growth venture capital might be is probably the way to go. Then equity versus debt is a second consideration. As I've been talking about, you need to give up ownership. Are you really willing to do that? Don't do it lightly. In terms of debt, you have to take on the debt repayment schedule. That's also something that's staying with you for a while. And once you started raising debt, it might be difficult raising venture later on, because if you have the debt obligation in your company, a new investor who comes in doesn't want to give you money to pay back your debt, but he wants to give you money to grow your company. So be aware of that as well. In terms of investor influence or control, you want to ask yourself, from whom do you want to raise money? Do you want to raise money from a pure play venture capital investor, like someone like HTGF, or someone like Early Bird, who invest agnostically in high growth startups, or do you want to take money from someone who brings some industry expertise or some industry network, like a corporate venture capital arm, like the investor arm of BMW, when you're having a startup that's somewhat car related, for example, or do you want the plain venture capital playbook? And with that type of investor, maybe that's the right point, the right time to make that point. You always want to understand why someone like Early Bird would give you money. They make 10 bets, make 10 startup investments, and they want to have one out of them who is the big fund returner, who pays them all their money back. And you got to be confident enough that you're that company, because if you're not, after 12, 18 months, if you don't show the growth curve, they're going to let you fall. Flexibility and risk. Number 4, take a long look at the term sheet. What's in there? What are the hidden costs? What are the long-term obligations? There might be things such as what are called structure on a round, something like liquidation preferences. What happens if you raise at 10 million, but then later on you only sell for 5? Who gets the first 5 million? Do you get something, or does everything go to the last investor who came in? Are there clauses that allow investors to kick you out of your own company and bring in new management? Those are things to consider. And then also in terms of time, how long does it take to secure the funding? Getting a convertible note is way quicker than raising an equity round. Raising an equity round, it's 4 months at a minimum. Even if you're having a great company, that can take 6 to 8 months to close the type of funding round, and takes a lot of time, takes a lot of talks. Moving on to maybe my favorite part, or like where I want to focus on. You really have to understand how your investor measures success. And I was saying, a generalist venture capital fund measures success in, hey, are you the 1 out of 10 companies that is my fund returner? Are you the company that pays for all my other failed investments? If you're taking money from a CVC, they might have a different risk profile. They might aim for companies that don't give them 10x on their investment, but maybe only 3, 4, 5x. But also the probability with which that makes sense comes into a materialization changes. And it's really important to speak with your investors early on their risk profile. Are they expecting 5x returns or 10x returns, and at which probabilities? Really ask your investor, what is for you a successful investment? For a bank, for a loan, successful investment is someone who pays back on time, every time, and doesn't default. And so you kind of have this scope from bank investor, like really low multiple expectation, low return expectation, but security. And then you have the pure play venture capital investor who wants high risk, high reward. And there's a lot in between, and you have to figure out where you fit in, and be clear with your investors on where they lie. And then on top of whom you are speaking to in terms of investor in general, it's also important to understand with whom you are speaking in the investment firm. Maybe some of you have experience in B2B and in B2B sales. There's always topic that's often comes up. There's the buying center in B2B sales, and I put here next to it the hierarchy in a venture fund or in a venture firm. There's also something like a buying center, if you want to look at it that way. If you're speaking to an analyst in a venture fund, he might have, or she might have, very different motives and motivations than a principal or a partner in a venture role. Most of you will first probably touch base with an analyst when you speak to a venture fund, and an analyst in a venture fund usually stays with the firm 1.5 years, 2 years. They don't care for if the company succeeds in 8-10 years down the road when you sell it. They care about having big name investments to their name that they can put on their LinkedIn. They go to the IC in the investment firm once a week, and they want to make deals. They want to push deals forward that make them look good, where they can say, hey, I've been part of that investment. Well, when you're talking further up here to the venture partner, the principal, the people who are actually having share in the fund, whose compensation is based on the performance of the investment they take, for them, questions like the cap table, questions like the return profile, the risk return profile becomes way more important. So down here, it's more storytelling. Up here, it's more Excel. And that's really something to be aware of with whom you're speaking to. Then coming to an end, I think I have about 3 minutes left. Some notes I want to share as someone who's speaking a lot to founders. And this is these are a couple of messages I would love a lot of people I speak to would know and be aware of. One is that being on conferences and on pitch events and whatever, that's all nice, but that's not where fundraising actually happens down the road. So I've met founders on 5 pitch events in the same year, and met them in January, and they were pitching on stage, and then I met them in June, and they were pitching on stage, and then later in October, and it's all nice, and they got great at having their pitch performance on stage, and their 3-minute pitch, they have it really nailed down, amazing, it sounds great, but that's not where you actually raise money. That's nice to gawk some interest, and I said earlier, you have like maybe 6 to 8 months that a fundraising takes. In the first 1 to 3 months of a fundraising process, you can pitch on stage. Afterwards, that's not where you should allocate your time. Like, don't go to tons and tons of pitch events, and obviously go to Founders Fight Nights. That's the before Jan jumps in. That's not what I'm saying, but do that only if you have a purpose. Don't do that don't expect to get a handshake fundraising agreement on a pitch event. Then the second one is really push for a decision in the timeline. You got to understand, investors get pitched to a lot, and it's really nice to say yes and tell startups, hey, I'd love to move on with you to the next stage, and I want to do the deal with you. Let's go. That's a great feeling. It doesn't feel nice to say no to people. It's not a nice. It's not a nice. It's not my favorite time of the day where I have to write emails and say, hey, this is why we decided not to invest in you. This is why we decided not to have a second call. That's no fun, and that's especially with analysts and associates in the early parts of the deal pipeline. They tend to say, hey, we're not interested at this time, but maybe let's speak again in 3 months once you've proven this traction piece, or let's I have 3 more follow-up questions, or I want to speak to this or that guy first. Can I meet your CTO again? That's all nice, but most often they're just avoiding to say no. And your job as a founder is to push them to move forward or no. Like, there's no point in having 5 people in your pipeline that you're still speaking to. It's a skill to bring people to say no early on in the process and not waste your time down the road. And lastly, don't take things personal. We give feedback to the founders whenever we can, and I always put to it that it's a highly subjective opinion, and every founder, every entrepreneur is using or is pursuing their venture or their company because they believe in it, and there's often good reasons for it. And if an investor tells you, hey, this is not for me, don't take it personal. Don't think the person doesn't thinks you're stupid or whatever, doesn't believe in your vision. That's all nice. Maybe the risk profile doesn't work. There can be lots of reasons, but go to the next one. If you have a good if you have a good product, a good solution, you'll find an investor down the road, or you do it alone and you bootstrap it. But don't question everything if you get a no. And lastly, maybe that's not on here, the only honest answer from an investor for why they don't invest is they don't believe that it's going to fit their risk profile, that they make the returns that they need under their fund model. That's the only honest answer. Everything else is feedback, but it's never, well, we didn't like that feature, or we don't believe the market size is big enough here and there. The only honest answer is we don't believe that this matches our risk profile, and we don't believe you can make it in that in the way that it would fit our investment. And yeah, this is usually a presentation that takes 45 minutes, so I was rushing a bit through it, and happy to answer questions where I might have jumped over things and moved a bit too quickly. Over to you, Jan.
Thank you so much. And I applaud in lieu of all the others that are maybe watching. Now, Erik, let's dive in with some questions while we actually asked our community before we went live here, if they could email us questions that can be answered, and so people may be able to watch that webinar in a replay at a later stage, and then also get to have their questions answered. First question that came up is, how long is the typical response time? Like if I send a pitch deck, or many VC companies or investment arms have this upload your pitch deck, upload your information here. When is it courteous to have a first follow-up?
Yeah, maybe moving back to this slide am I still sharing? Probably not. I can answer it without the slide, no worries. It really depends whom are you sending it to, and at which level of connectivity. Let's put it that way. So if you upload it through the website, where does your pitch land? Your pitch lands somewhere down here. Then somewhere with an analyst, with an associate, and they're going to screen through it, and they're going to say, does it have a big chance of becoming interesting? Maybe, maybe not. They don't probably feel very obliged to answer. Just uploading through the website, that can take 3 weeks, that can take 4 weeks if they're busy with other deals. Sometimes you don't get an answer at all. To be quite frank, also depends a bit on, did you do your research before? Does your pitch deck really fit? A lot of people stop answering pitch decks that come in if they don't fit the criteria very well. So if we have the same button on our website. If someone uploads a great company, but it's a Series A startup, and I say on my website, well, I invest pre-seed and earlier, it takes time to answer. If you come in up here and you send your pitch deck maybe through a warm intro to a partner or a principal, and you met someone at a conference, it's an old colleague of yours, you connected via LinkedIn before, or for example, after this YouTube session, you ping me on LinkedIn and say, hey, I've seen you here and there, and I like that thought, and Jan told me I should talk to you. Usually you can expect should be able to expect a reply within a week. Always be wary, maybe that's my last note on that, how big is the team you're speaking to? For example, we are a team of 3. If one of us is sick, one is on a conference, and the third guy is busy with a deal and sitting at the notary, it might be 2 weeks. If you're speaking to like larger funds who have 30, 40 people working for them, the response time should be shorter.
Great answer there. How many VCs should I contact and where do I find them? I know this person who asked this, and they're about to fundraise, and they're a bit worried that if they reach out to 10 VCs and get a response rate, and I told them, well, look, always be fundraising, so you may want to actually contact 100 VCs if they match what you're doing, and if you can provide a good match to, I guess, their risk profile. But where do you stand on that?
It's tough to get an answer to give an answer on that one. How do I say that? I think it really depends on the stage which you're fundraising. I assume the person who asked that is raising for the very first time. Is that am I guessing correct? So we're not talking about we're talking about earliest fundraising, and if we're talking about like angels or like quick round, 10 can be enough. It's better to reach out to 10 and actually if it could it's better to have 10 warm intros than to send out 100 cold emails. So focus on the ones where you have a connection already, or where you can get a warm intro. And it goes up to, we have startups in there when they raise seed rounds or Series A rounds, you have like Excel files with 200, 250 contact rows in there, and you imagine, okay, first batch, second batch, and I'll reach out. In the first 2 weeks we send out here, then we shift our pitch and make some A/B testing with investors. In later rounds, I would totally agree. It's like a funnel, and when the top funnel is full, something will come out at the bottom. But the earlier you are in the process, I think targeting and being focused is more important than reaching out to a lot, and don't over systemize your fundraise too early. If you raise over $1 million, you can open an Excel and structure your intros and think about all that. Happy to talk to whomever asked that question and share a template. But if you're raising an angel round, first funding, don't make it too complex. Just go out and focus on the warm intros you have.
And now on to my final question. The second part of the question was, where do I find those? Now, you've mentioned those warm intros, and I'm happy that you caught your drift. And you said, obviously, the Founders Fight Night being the major exception to all of these worthless pitch competitions out there. So that is where you can definitely get a warm intro as a consequence of being drilled and grilled on stage. But where do you say, because often, obviously, those larger ecosystem events, you tend to meet the juniors that may or may not actually can provide an entry point. Also, I feel it's not only about finding them, but also finding the right ones. We know of lots of people who say they'd love to invest in startups. Unfortunately, they don't have any fund available. And so it's difficult for the VC that would like to invest, but maybe they have a fund that's already in a mature stage and they don't have any free liquidity to place new investments. So how do I find them, and how do I qualify before I'm wasting my time? Or is a consultant, all of these consultancy services out there that promise me easy routes to money, easy intros to angels and VCs, is that the route to go?
So second of all, I'd like to answer on the second part first. If I get an email from someone raising on behalf of someone else, that's a major red flag, because I'm investing money because I believe in the person being able to raise further money later on, to raise in the future. So If the person is not able to raise money right now, that gives me major question marks on, are they going to be able to raise money in the future? And if they need a placement agent, well, that's a tough one. If you're talking Series B and later rounds where it's larger tickets and you have some mezzanine part of the fundraise or whatever, different story. But the early stage, it has to be the CEO, and that's the only one I want to be approached by, not by someone raising on behalf of them. And then maybe to the first part, I think it's all about exposure in the early part of your fundraising. Or if you're, as you said, always be fundraising, or when you're not fundraising, going to pitch events and building the network, that's the way that's great. And like, once you don't go to those events to close a fundraise, go to those events to build your network, to build your contact book. That's what events and being out there is all about. I mean, it's great to hang out on LinkedIn and on YouTube or whatever, but you meet people in person, and that's how you stay in memory. And if people like you, if you're nice, there's always a culture of paying forward. So I think if you give something to someone, you'll get something back. And I mean, after this, everyone who sees this right now can ask Jan for intros and can ask me for intros. So that's already part of networking you've done today. There's no secret list hidden in the internet somewhere where you can see all that. And maybe the third part that was in your question was how can I qualify if they actually have money to invest right now? And that goes back a bit maybe to this point, like really push for answers early on. So maybe ask those questions early. Don't talk to the analyst on, our business model and our market size and this is our margin and we have this pilot customer. Like, it's always an interview in both directions from the very beginning, and like ask those questions early. Hey, where are you in your fund life cycle? Are you actually investing? What was your last investment? Those are super relevant questions. Like if I speak to a founder for 30 minutes, first time we speak and they don't have any questions for me, that's a bit odd, because that seems like they've just been talking to anyone.
Perfect, Erik. Thank you so much. Thank you guys out there watching, either live or watching the recording. If you have any questions, you want to reach out to us or to Erik, feel free to shoot an email to team@Founders Fight Club or add us on LinkedIn, and we'll be sure to also do a lot of highlight clips of this video and spread it wherever we are on social media. Thank you so much, Erik. Thank you so much for spending time. And with that, we are out.